$11 billion. Let that number just sink in for a second. This absolutely staggering figure represents the massive accounting fraud committed by WorldCom back in the early 2000s. It was an event that literally sent shockwaves through the entire global economy. Their management fraudulently took everyday operating expenses and recorded them as capital expenditures. It was a massive deception that artificially inflated their profits, and when the dust settled, fortunes were completely wiped out overnight. So, with this devastating loss of both wealth and trust, everyday people, investors, and regulators were left staring at the foundation of our financial markets, asking one incredibly terrifying question. Can we actually trust financial statements at all? Are auditors actually independent? And is anyone at the top even accountable? Society quickly realized that just having technical accounting knowledge wasn't enough anymore. The whole system had a fatal underlying flaw in its ethical judgment. So, how on earth did we fix this mess? Welcome to this explainer, where we are going to cover absolutely everything you need to know about the Sarbanes-Oxley Act, or as you'll constantly hear it called in the business world, SOX. Enacted in 2002, this wasn't just your standard regulatory update. It was a full-blown emergency intervention by the U.S. Congress to literally save the financial system and restore public faith after a parade of catastrophic corporate scandals.
To help demystify this massive piece of legislation, here's our roadmap for today. First, the corporate scandals catalyst. Second, the birth of SOX. Third, the core provisions and rules. Fourth, embedding ethics in law. And finally, number 5, the global compliance legacy.
All right, let's kick things off with part 1, the corporate scandals catalyst. Because before we can really understand the cure, we have to take a hard look at the disease. Companies that were once seen as absolute, untouchable titans of industry were suddenly being exposed for incredibly weak internal controls, widespread dishonesty, and prioritizing pure greed over professional skepticism. You had Enron hiding billions in debt using shady off-balance sheet entities, WorldCom, as we mentioned, manipulating $11 billion in expenses, and Arthur Andersen, which was one of the world's largest audit firms at the time, not only failing to stay independent, but actually getting caught actively destroying audit documents. These weren't just math mistakes, right? They were systemic ethical failures. And what's really wild is just how incredibly fast this entire crisis unfolded. Think about it. In 2001, Enron collapses, wiping out thousands of jobs in everyday folks' pension funds. By early 2002, WorldCom's massive fraud hits the news. The bleeding in the financial markets was so severe and so fast that by July of 2002, the U.S. government had to mount a totally unprecedented, lightning-fast regulatory response just to stop the bleeding. Which brings us right to part 2, the birth of SOX. Now, the birth of this law was a direct product of intense, boiling public outrage. People were furious. Driven by Senator Paul Sarbanes and Representative Michael Oxley, this federal law aimed to instantly improve corporate governance, force transparency, and protect vulnerable investors. The Senate and House reconciled their bills at breakneck speed, and President George W. Bush signed it into law on July 30, 2002.
And the core philosophy of SOX really boils down to this perfectly captured idea. Doing the right thing couldn't just rely on personal morality anymore. Organizations had to build systems that forced ethical conduct and caught the bad actors. Before SOX, we left corporate ethics up to chance, and that clearly failed. So lawmakers decided ethics had to be institutionalized. They had to be hardwired directly into the corporate machinery itself.
Okay, let's get into the actual mechanics of how they did that in part 3, core provisions and rules. These rules fundamentally changed the day-to-day reality for executives and accountants. See, before SOX, auditors essentially regulated themselves. And as we saw, that was a disaster. Section 101 ended that era of self-regulation overnight. It created the Public Company Accounting Oversight Board, or the PCAOB. This established a powerful, independent watchdog with the authority to regulate auditors, inspect firms, and investigate misconduct. Suddenly, the auditors had an auditor. Then we have Sections 201 and 301, which went straight after those massive conflicts of interest. A huge reason Enron got away with so much was that their auditors were raking in massive consulting fees from them, totally compromising their objectivity. Well, SOX effectively banned these cozy relationships. It stopped auditors from providing certain non-audit services to their clients and forced companies to build audit committees made entirely of independent directors. Management couldn't just dominate the audit process anymore. Now, Section 302 is easily one of the most famous parts of the entire act.
It grabs the highest levels of leadership, the CEOs and CFOs, and forces them to take direct, personal, legal responsibility for their numbers. They actually have to personally sign off and certify that the financial statements are accurate and that they aren't hiding any material misrepresentations. And because of Section 302, the all-time classic executive excuse of, well, I just didn't know, was legally completely destroyed. You couldn't just sign off on fraudulent numbers and claim you were out of the loop anymore. Then there's Section 404. For the accounting world, this is arguably the heaviest hitter in the whole act. Management now had to rigorously assess, document, and actually test their internal controls over things like cash, revenue, and payroll. Because of 404, hiding financial fraud became infinitely harder. It completely transformed auditing into a much more risk-focused function. But what if someone still tried to cheat the system? Well, SOX brought some serious consequences. Section 802 introduced severe criminal penalties. We're talking actual jail time for destroying or altering financial records. And crucially, Section 806 gave vital legal protection to whistleblowers. By protecting the employees who had the courage to speak up and threatening prison for the executives who tried to cover it up, SOX engineered a completely new culture of accountability. Moving on to Part 4, Embedding Ethics in Law. What's really fascinating here is how this law took abstract ethical concepts and literally turned them into strict legal mandates. Just look at this mapping. Integrity, the idea of just being honest, is now legally enforced by Section 802's criminal penalties for faking records. Objectivity is guaranteed by Section 301, forcing audit committees to actually be independent. And professional competence, that's demanded by Section 404, requiring strict, tested internal controls. Plus, Section 406 stepped in and mandated that companies officially disclose whether they've actually adopted a formal code of ethics for their senior financial officers. By forcing this out into the open, corporate ethics went from being this nice, optional buzzword to a strict, highly visible requirement for the organization. Finally, let's zoom out for Part 5, the global compliance legacy. Looking back, what is the real long-term impact of all this? Well, it hasn't been without its critics, that's for sure. The administrative burden of compliance, especially testing those internal controls under Section 404, costs an absolute fortune, and it can be incredibly overwhelming for smaller firms. But on the flip side, many experts argue that this massive price tag is absolutely worth it for the return of market trust, transparency, and investor confidence. And these ripple effects certainly didn't stop at the US border. SOX basically became the global benchmark. For instance, nations like Nigeria adopted a lot of these exact same principles through their Financial Reporting Council and SEC. The Nigerian Code of Corporate Governance heavily mirrors SOX when it comes to things like board independence and robust risk management. It truly reshaped how the entire world views corporate responsibility. So as we wrap up this explainer on the massive ethical revolution that was the Sarbanes-Oxley Act, we're left with a pretty profound question. Did paying this heavy price of compliance actually buy us a permanently fraud-free future? Or did it just force corporate greed to evolve into something even more complex, meaning we have to be more vigilant than ever? It's definitely something to chew on the next time you're trusting a company's financial statements. Thanks for joining me on this one.